program. And I'd like you to help me to welcome to the stage to give us our keynote presentation. That is Luz Maria Salamina, who is the lead financial center specialist, International Finance Corporation. Please, if you can join us, Luz.
Thank you so much. Karibu. Karibu Tana. I have mastered the language. So I am your panel, and Edwin is my moderator. So welcome, Edwin. I guess I'll leave you to lead the moderation after I give my presentation. So we move forward. Let me see if this works. And now I have to handle a clicker and a mic. So it's so good to see so many of you that I know already. You look much better. COVID has been good to you. This is where our story starts. Our story always starts here when we talk about credit. Three possible outcomes when lending, right? To approve a good client, which is the expected result.
Directing that cycle to credit bureaus, to regulators, to lenders, banks. Who are you saying should be involved in this?
I think Colin already contacted those that not go to the beach. And if somebody is planning on going and would like to participate here, please contact us. But we need a representation of the industry. We need regulators. We need credit bureaus. We cannot have all credit bureaus in the committee. This is a very special standard-setting body. It is probably the only one that has a representation of the private sector, and we need to keep it that way. So we did kind of a negotiation. So the private sector is represented by associations. So make sure that your credit bureaus associations are well represented, are well informed, and bring the information back to the committee. But also that regulators across the continent are interested in being part of that committee. If they have to be consolidated and represented regionally, let it be. But we need that. So this is our call for you. So the 5 general principles, how much time I have? Like how much? 10 minutes. Okay. 200 slides for 10 minutes. 5 general principles on credit reporting. Data. I should ask you to tell me those. Data, security, governance, legal reforms, cross-border. Who is responsible for each? The CEOs of all the credit bureaus are responsible for data and security. The board of directors are responsible for what the CEO does. Okay? Regulators, legal frameworks. Legal frameworks that are clear, that are flexible, that allow for growth. Cross-border. We need to start working on international agreements. Data. GP number 1. And now, because I have 10 minutes, I'll run. It has to be relevant. And years before, relevance of the data was, or data that was relevant was, okay, any credit that is already out there. Now that has changed totally. While before we thought that maybe having information on a mother with 5 kids and 3 of them going to school could have been a good variable for measuring their capacity and willingness to pay, now we have that information available. And that now is relevant, accurate, timely, sufficient, and I cannot believe that there are still countries that only report negative data to the bureaus. The only way to actually approve a loan is to know the positive data, right? What can you do with the negative data? Deny a loan. and time. There is some tendency lately, even in my country, to lower the time of retention of data. Sometimes as low as once the credit is paid, take it out of there. It doesn't make sense. History is what gives us the actual understanding of that individual. If somebody had a bad loan 2-3 years ago and has improved, isn't that the best information that an officer can have in terms of demonstrating the willingness to pay? On the contrary, if somebody is now delinquent, they cannot show, unless you have history, that they have been good borrowers and that they actually are probably going through a bad financial time. Historical data is so important. And you know what negative and positive data is, but remember what is the push of approval rate when you add positive data. 89%, and these are figures from 2000. Now, it's probably even more. Comprehensive information sharing. We're still in GP1, and I have 7 minutes. What data type is important? Financial data will always be important. Non-financial data that we already can say is traditional data, like information from civil registries, identification registries, public registries, utilities data. Now alternative data is so vast, and that is what we want to conquer. What is the alternative data? The one that hasn't been used before, that is relevant. What are the variables that make it occur? And the growth in terms of approval rate, 11% only with the data that we already know. So this is what is important for us. And this is probably the basis of the conversations that we're going to have these 3 days. There are potential borrowers that are still not in the system. So who is in the system? In the system are those that have credit history, that have some sort of digital trace that we can also look at, that have high scores, and everybody wants those customers because those are the good customers, and you approve immediately. Then there is this gray area with those that have medium scores. If you are too conservative, even with medium scores, it's easier to deny than to try to look for the movable collateral or to look for other ways of minimizing risk, as there are some new alternative data. And then there are the low scores and the credit invisible. The credit invisible has no score in the traditional world, and they are rejected. And this is what you're missing, guys. 65 million potential clients. This is the world. So you can even go away out of Africa and get some loans. An MSME gap of 5.2 trillion. And the reason for them not getting loans is they're informal, no record keeping, no collateral that is accepted, no transactional evidence, financial skills, history. 5 minutes. Then we analyze the challenges because we started looking for ways to incorporate alternative data. Unique identifier is still an important challenge. Fragmented data sources, difficult to bring all of them together. Completeness and timeliness. Lack of digitized data, particularly for those that are in the bottom of the pyramid. But there is an abundance of digital data that has been increased more than ever and because of COVID. So in addition to you looking better, also we got more data thanks to COVID. So we face this great amount of data that a lot of new companies are using already, granting credit, some of them outside of the regulatory framework, that is making the regulators a bit uneasy or not really knowing what to do with that. So, ICCR comes to the rescue. But we did think about what would be the main principles or guidance that could start allowing us to use this alternative data. So we came with 4 main categories: improving the availability, because not all the data was really available in a form that can be used; expanding credit information, so it would not cover only banks or regulated entities, but retailers, traders, digital lenders, mobile money, all of that. Enabling cross-border data. And for regulators, let's sure that you keep the balance and the integrity. So for us, the ones highlighted are the most important ones. Unique identifiers, particularly in Africa, are still not available in every country. And the World Bank has a lot of initiatives, different other multilateral organizations have them. But you know what, it really depends on the country, on the willingness and the efforts that you put into this. In Uganda, actually, they managed to bring a lot of people to use the unique identifier that has been issued with very rigorous processes. Open data systems promote the use of digital platforms. Cross-border collaboration, harmonization of data protection, and data protection is coming hard. So anything you do, think about the consumer. Think about the rights of the consumer, the privacy, the data protection, the data privacy, and all of those topics, because the consumer is king. And the consumer is the one that generates the data. Alternative data and alternative scores allow for lending to previous invisible. We have an SME that has credit information and they get a traditional score. You get an SME that either has thin or no information. They may have some limited credit history, and here is where the magic comes with alternative data. We have the one that has limited credit history, the one that has no credit history, or not even digital trace. There is this psychometric that has had good and bad publicity, but I think that they are overcoming some of the challenges from the beginning, and it's giving good results, particularly for those that have absolutely no data. And then for those that have some limited information, there is a push that they can get from alternative information on from digital means, and you can get then 3 types of scores. Traditional scores for those that are your typical customer, psychometric scores for those that have nothing, and composite one for those that may need a push, that you currently are denying credit, that could also be good customers. So we are working on pilots. So again, if you have an idea of a pilot that you want to implement, talk to us. But this is what we started thinking a few years back. It has been modified, but there's basically 3 hypotheses. MSMEs that already use digital platforms, they have digital trace, there should be some data analytics that we can work on them. You lend, we look, we observe together with the regulator, and then we see what are the potential gaps, how can we propose enhancements for boosting what is already there. Then there are some SMEs that generate some data, but do not use digital platforms. Information exists, not in a digital form, is hard and expensive, rudimentary analytics. For them, the old way of lending to micro entrepreneurs, lending is very little and very costly. what do we want to do? Promote the use of platforms. Some exist, but we need to complement them to be able to run with these new potential customers. And for those that do not generate any data, that are maybe in the rural areas where there is no digital means, let's help them develop these platforms so that they can start using the tools that are available for most of the rest. And the use of scoring with that data has improved in the results. So before mobile, default rate 33%, after mobile 15%, rejection rate before mobile data 92%, rejection rate now close to 20%. So we want to just expand those, and we want to make sure that mobile information is part of the whole ecosystem, and that is still a challenge. Solution for everything, or at least principles and guidelines. So for credit scoring, we also have some principles. But one is that the decisions made through credit scoring should be explainable. This is the only thing.
We'll have some people coming to talk to you maybe during the break and just get the really detailed presentation for those who would like to get a copy of it. I'm sure Hannah and her team would be able to provide for. Would that be okay, Luz, if we share your presentation?
My pleasure.
Okay, fantastic. Edwin, over to you.
Good morning, everyone. Once again, Luz, thank you for such a comprehensive presentation. There are a couple of things I think for myself which I've grasped, and I would like as well to give some insight. Consider the experience that you have spanning from the auditing to the banking sector within HSBC, and also you worked at the Credit Reference Bureau in Panama, and now at IFC as a lead financial sector specialist. I think most of us were quite aware of some of the key issues that she has touched in her presentation, specifically at the end in terms of some of the modality for data sharing or reporting. What has been the key challenges to different markets or regulators, especially this part of the world where you have Kenya, Tanzania, and Uganda? Most of them with different modality in terms of how credit information being reported to the Credit Reference Bureau and subsequently to the subscribers who are commercial lenders. What are the main challenges you think of different adoption that you're currently having now?
Thank you, Edwin. So for me, one of the main worries in Africa, and not necessarily in the countries that you mentioned, is the unique identifier. If you do not have a way of uniquely identifying your customer across the whole ecosystem, the risk of over-indebtedness, the risk of default remains high. So we need to work on this together, individually, but it is not possible that nowadays, with so much technology available, with so much digitization, we cannot uniquely identify each one of us. That is one. I think that because of also this expansion of digital information, it is important to bring them to be used for credit on the right way, in the right way, by all the players, as many players as possible. We saw the gap that exists there. We cannot all try to concentrate on the top best customers, because again, that is the easy way. Then we will again try to make up these creative ways of making money with only them, and then we might end up in another crisis. So we need to try to avoid that and take advantage of the technology, the digital trace that all of us are living, and those that do not have the capacity of living that digital trace, bring the tools to them. It is cheaper now, it is easier. It takes some work, but that is what will make a great difference in our economy. And then let's start that conversation about the relationship between the regulator and the private sector and make sure that it works well and that it provides the right tools for all of us to perform within our role in the best way.
I think that's a quite fair point, Luz. As well, there is one component which, and I'll speak from my own experience in Tanzania, that we noted. Over the last 7 years, we've noted exponential growth on digital lenders. For instance, right now, we see crediting, I would say about 52 to 55% of the data subject that we're currently holding is actually coming from the digital lenders. This was a population that were deemed to be unbankable in the past, but more likely, these are digital customers that are coming from MNOs. So the challenge that we are having right now is how do we migrate such a population now to the banking community? Otherwise, they'll remain stagnated within the MNO space. I mean, you understand quite clearly, I mean, when it comes to digital lending spaces, it's always a combination of banks, MNOs, and perhaps a fintech company. So to what extent, or what are the key issues that you think, from your experience, that needed to happen to ensure that there is a smooth transition for such addressable population to the mainstream lenders or banks?
Yeah, that's a difficult question. So the first thing I would say is embrace digital lenders. Embrace the digital exponential burst that is happening. And maybe start thinking outside the box and not necessarily think the old way of how to make them transition to, but how can we work in a different manner? How can we integrate all of these new players in this ecosystem and that work for all of us and take the benefits of all of that? So I wouldn't say necessarily because you are informal and you don't have a bank account, then the next thing for you to do is to formalize and have a bank account. There may be some transitional steps and activities and things that you would need to do to really believe that you need to be formal to then grow. And again, we are testing some of these through exercises to see if there is a trend or a commonality that we can then scale. Sorry, I don't have the perfect answer for how to transition from non-banking to banking.
Okay. I think you'll be interested to hear from the audience as well as we open the Q&A. Martin.
Put you on the spot in terms of Tanzania and the bureau that you run. But I want to link it back to Luz's presentation, because there were two things that came out very clearly, well, to me anyway, with some insider knowledge in terms of a little bit about Tanzania. One of them is the lack of identification in Tanzania. And maybe you can talk to us about that, because I get what you're saying about the digital data coming in and showing a bit, kind of more data on the bureau, but I'm really keen to get an update and hear from Sia what goes on with the inability to accurately identify people at the bureau from a national ID point of view. And then the second one is that one of the models that Luz showed in terms of the public credit registry model and the work that's kind of going on within the World Bank at the moment in the direction already actually exists in Tanzania with the credit data bank. And I'm very keen to hear from you guys how that works in TZ, because it's very different to how it works in Kenya compared to Uganda, even Rwanda, in that all the banks are reporting to the credit data bank. My understanding, and if you can please elaborate, is the bureaus then can't access that data for building value-added products. And I'd really like to hear more about that.
Recall correctly, since you presented the hybrid model, you have a regulated institution, and when I'm referring to the regulated institution, these are deposit taking, more like commercial banks and the rest. They are sending or they are reporting their data to the central bank, where the data bank sits, and then the central bank is pushing that data to those bureaus. So that's one leg. The second part is that any digital lender, including deposit taking, so long as you have come up with any digital product, you are not actually mandated to submit such information directly to the central bank. You can submit it directly to the bureau. And rationale, the reason is very simple. When the data bank was created, the data structure does not really conform to the new data structure that was approved by the central bank for the digital lenders. So hence you have digital lender now are submitted direct to the bureau. It could be that you are submitting a conventional portfolio direct to the BOT or the Bank of Tanzania, and then your digital lending product will actually push them direct to the bureau. So we are supporting the majority of the lenders here in that aspect. The second part of your question was around banks are allowed to collect up to 5 forms of IDs. You can have your national ID, passport, driving licensing, voter's ID. There are about 5 IDs that are currently mandated by the regulator. But when it comes to the digital lending space, so long as you are partnering with MNOs, you are actually required to use the national ID. So that's where the situation is. And then you find them, we're in a situation where the data that is coming from the digital lenders is actually of higher quality. And completeness is actually almost 100% compared to what is coming from the conventional space. So it's an open hybrid in terms of also.
I'd like to know whether you're thinking about where the best place for that data is. Is it the credit bureau, or is it some other institution, or is it some other way that all data can speak to credit information data, so we don't get...
Or challenged by the data providers when there are multiple recipients of that data, because they incur in additional expenses, they have to comply with the rules of one, the rules of the other, and then there is this disaggregation of information that is not good for the system. So I don't have a solution for that, but that is an issue. That is an issue that has to be discussed, that they are being treated differently in different parts. There is the data hub in some places. It is hosted by the regulator in some ways. In others, there is a totally different entity that is managing that. But then, it has to be sustainable, right? And it has to have the proper availability of tools and technology to provide the services to the beneficiaries that are very sophisticated, which are banks, fintechs, financial institutions, non-financial institutions, digital lenders, and all of them, for the ecosystem to work. So I don't have an answer for you, but it is still a challenge that we are still looking for solutions, and probably solutions will be different for each country depending on what the status of the reforms are, where the platforms that exist are available, and many other variables. So you are welcome to also provide us some recommendations for that. I think at this time, and I mentioned it before several times, there are more benefits in sharing than not sharing. Even if we think that these are our unique customers, they really walk around. In terms of collateral registry, that is the only point that I didn't mention, and it's very important. And there needs to be, there is the need to also create a valuator system, a set of either a board or some sort of body that can have enough skills and certifications to provide guidance value for those assets. So thank you for that question.
Okay, Luz, thank you so much for the presentation.